Imagine working a full 40-hour week, but when your paycheck arrives, your employer tells you that 10% of your labor simply didn't count. You'd be outraged. Yet, this is exactly what is happening to your bank account right now. In 2026, inflation in the UK isn't just a headline. It is a structural tax on your future. If your money is sitting in a standard high street savings account, you aren't saving. You are losing purchasing power every single hour. Today, we're dissecting the math of how inflation destroys London earners and the specific maneuvers you must make to stop the bleed. Welcome to HustleWise UK.
Inflation is the decrease in the purchasing power of money.
In London, real-world inflation often outpaces official figures because our biggest costs, rent, energy, and transport, rise faster than the price of consumer goods. If you have £10,000 in a 2% savings account, but inflation is at 4%, your real return is -2%. Your bank balance might say £10,200 after a year, but that money only buys £9,800 worth of goods in today's terms. Pro tip: stop looking at nominal value, the number in your app, and start measuring real value. If your net worth isn't growing by at least 5% annually in this climate, you are technically getting poorer. The UK's biggest banks thrive on your inertia. They offer teaser rates that drop after 12 months or cap your deposits at small amounts. In a city like London, holding excessive cash is a high-risk strategy. To stop inflation, you must transition from a saver to an investor. You need assets with pricing power, investments that increase in value because prices are rising. Pro tip: your primary shield is the Stocks and Shares ISA. By investing in global index funds, you own pieces of companies that can raise their prices to combat inflation. This protects your capital, while the tax-free wrapper of the ISA ensures you keep every penny of growth. Inflation is a nightmare for savers, but a stealth friend to those with low-interest, fixed-rate debt. If you have a mortgage at 4% and inflation is at 5%, the real value of what you owe is actually shrinking. However, dumb debt like credit cards will destroy you. Their rates are designed to stay significantly above inflation. Common pitfall: many Londoners use credit to bridge the gap created by rising prices. This is a trap. HustleWise UK rule: never carry a balance. You cannot out-invest a 25% interest rate. The final defense is structural. You must lock in your biggest costs. Move from renting to a fixed-rate mortgage as soon as possible to freeze your housing expense. Secondly, invest in yourself. The only asset inflation cannot touch is your earning power. In London, spending £1,000 on a high-value skill often returns 10x more than any stock market gain because your salary can then outpace the cost of living. Inflation is a tax on the uninformed. But for the strategic earner in London, it is a signal to move capital into productive assets. Don't let your hard work evaporate. Take control of your real value today. For more deep dives into mastering the UK economy, subscribe to HustleWise UK. Hit the bell, and I'll see you in the next session. Visual: fade to black. Text: subscribe to HustleWise UK. Social handles: Spay,